I'm going to break down the various different life strategy funds offered by Vanguard by talking about what they are, how they work, who they are designed for, and whether they have a good risk to reward balance. And all I ask in return is that you drop me one of these for the YouTube algorithm. Disclaimer, I am not a financial advisor, and if you seek financial advice, please see a licensed professional. Firstly, Vanguard is an investment managing company with $6.2 trillion of assets under management, meaning they hold $6.2 trillion of customers' assets that they look after according to their current market value. Vanguard is the largest mutual fund provider and the second largest provider of exchange traded funds, which means that you've likely seen their funds before. However, what makes Vanguard so special is that they usually offer lower fees than their competitors in the industry, typically making the funds more accessible for their investors and cheaper, therefore making it fairly ideal for most investors. Amongst many of the exchange traded funds /ETFs that Vanguard offer, Lifestrategy is one of the most popular for UK investors. So what are the life strategy funds and what are their purposes? Well, the life strategy funds are a range of simple, low-cost portfolios with differing amounts of equities and bonds so that you can make an informed decision based on your risk tolerance and invest in the market passively without having to worry about choosing individual stocks and keeping track of them. These funds are designed for individuals looking to invest in their future by building up equity over the course of their working lives, effectively meaning that they passively invest a portion of their paycheck into these funds, and therefore compound interest can build up and passively over the long term generate a lot of money using the magic of compound investing, so that in future they can choose to withdraw or sell out some of their funds and use it for income that they could use in retirement or whatever their needs are. As you likely already know, there are 5 different offerings under the Life Strategy brand. That is LS20, LS40, LS60, LS80 and LS100. And it's actually a lot more simple than it sounds. The numbers next to Life Strategy simply represent the amount of equities and bonds in the fund. Equities are simply stocks or shares, and therefore when the stock market rises, the equity portion of the fund will likely rise too. However, in a market downturn, don't forget that these equities will also drop. However, bonds don't typically follow the stock market, and therefore when stocks drop in a time of uncertainty or great volatility, bonds usually hold their value, if not increase in value. Therefore, it can provide you with well-needed diversification to preserve your capital that you have invested in the funds. If you were managing your own portfolio, you could sell out of the bonds and buy equities when they're cheap, which allows you to minimize your risk in the market. The numbers of the Life Strategy funds simply means the percentage allocated to equities in the fund. For example, Life Strategy 80 would mean that there is 80% allocation to stocks and shares and a 20% allocation to bonds, whereas the Life Strategy 40 would mean there is only 40% allocated to equities, aka stocks and shares, and 60% allocated to bonds. When looking at the historical performance of the Life Strategy funds, you would see higher returns based on the higher the allocation of stocks, and this is also a common long-term trend that most investors are aware of. Over the long term, stocks are very likely to outperform bonds. However, in the short term, bonds are lower risk and therefore can be a well-needed safety net if needed in a portfolio. Therefore, in a 5-year period, if you invested with Life Strategy 80, you would have gotten returns of 38.93%. Whereas if you'd invested with Life Strategy 40, you would have got a reduced return of 29.61%. However, this comes at a cost, and this cost is volatility. The more stocks or the higher the allocation of the stocks you have in your portfolio, the more it can go up and down. So if the market drops by 50%, if you're with Life Strategy 100, your fund is going to drop by 50%. What I must also say that whilst stocks are a higher volatility, this does not guarantee higher returns, therefore making them high risk, but potentially, yes, they have high reward, but at the same time they could also underperform bonds, although this is very unlikely over a medium to long term period. Typically, the younger you are, the more time you have to wait out a stock market crash, correction or bear market. A younger person could easily wait 10 years of investing consistently in the market and therefore see their capital return to where it was 10 years prior. because they have that time. However, someone nearing retirement that perhaps retires in less than a year, if the stock market drops by 30%, they have to make a choice whether to take their money out at a 30% loss, assuming it's the Life Strategy 100 fund, or wait potentially a decade until the stocks recover and therefore delaying their retirement. So this typically means that the closer you are to retirement, the less stocks you should have in your portfolio, and subsequently the lower risk you should be looking for. Rather than growing your capital rapidly, you should be looking to preserve it. And therefore you should have a greater proportion of your money in bonds. And 60% of you aren't subscribed. It doesn't cost a penny and it is free, so please consider subscribing. Thank you. If you've looked at ETFs/exchange traded funds before, you very well may have noticed there's two different types. And that's income versus accumulation. This is basically how you would like to receive your dividend payments. Dividends are returned to the investor from funds, stocks or shares, and even income bonds that offer a interest rate. So you have the option with income to be rewarded this in cash, or with accumulation you can receive this in the share price of the fund. It is worth noting that if you really want your growth to compound, then having an accumulation at a younger age means that over the long term you'll have a much higher reward. Whereas if you're nearing retirement, it might be wise to switch to income so that you can use that income to support your retirement without having to necessarily sell off your funds and therefore preserve your capital whilst living in retirement. However, bear in mind, if you're investing outside of an ISA or a pension plan, then you should make use of the capital gains allowance of £12,300 and the dividend allowance of £2,000. However, this is in 2020 and it is subject to change. You could avoid tax by creating a balance between your income and accumulation. If you have enough income funds to just about generate £2,000 or just less than £2,000, that would be tax-free. Then if you had enough accumulation where you could sell off a portion of your profits and only take £12,300, then you would be able to tax-free withdraw, and this would be your option when using a general investment account. And then you can slowly siphon or sell off your investment if you do this in separate tax years and therefore get tax-free returns on your money. However, a big issue that eats into the performance or the return of many investors' capital is fees. Since typically we can expect an annual average return from the Ftse 100 of 7.5%. When factoring the rate of inflation set by the Bank of England, which is 2%, meaning that in 2021, £1,000 right now would only have a spending power of £980. Then also factoring a standard traditional fee offered by many funds or active management portfolios on the lower end of 1%, only have an annual average return of 4.5%. Meaning that if we deposit £10,000 and leave it for 30 years, an annual average rate of 7.5%, we would have £87,549. However, if we were to do the same but with a compound interest rate of 4.5% but still investing £10,000 and leaving it for 30 years, you would only have £37,453 in that same time frame. Meaning it is very important that you look as an investor to reduce your fees so that you can increase your long-term returns. So how does Vanguard's Life Strategy funds compare to that of other funds in terms of fees? Well, actually, Vanguard are one of the cheapest offerings around, and they offer an ongoing charge figure of 0.22%. However, it's not just charged on an annual basis, and in fact, you won't even notice this money is being charged from you. Each trading day, a very small amount of the fee is taken off of the share price of the fund. And so whilst yes, it is 0.22%, if for instance there was 200 trading days in a year, then you would effectively divide it by 200. And this is actually, according to which, is a lot better than many other funds offered. And the more active managed funds have fees ranging from 0.75% to 1.5%. Despite the incredibly low fees, there are some serious risks involving the Life Strategy funds, and I'm going to tell you them now. Firstly, they have a very high exposure to the United States market with 40%, assuming we are talking about Life Strategy 100. which is understandable because it is the most globally dominant market that in recent history has also provided the best returns. However, we should take into account that they now have much higher potential downside, and this is because of two compounding factors. Firstly, since the pandemic crisis, the Federal Reserve in America, which is basically their regulating bank, has put a lot of money, and I'm talking like $4.5 trillion, and they've invested that straight into assets. So they are effectively propping up the stock market, and now currently the stock market is at all-time highs. This means that when they stop using quantitative easing, that the stock market could start to drop. Furthermore, the second risk could mean that the US elections are coming up in November 2020. And whilst there shouldn't be a medium to long-term impact on this, this could certainly lead to a short-term market crash or correction if the outcome is not favourable, especially because some of them were pushing certain laws that weren't looking too promising for the United States stock market. Also, since this is a UK offering, a significant portion of the Lifestrategy funds, aka around 20%, when looking at the LS100, is actually invested in United Kingdom equities, which doesn't sound like a bad thing, right? But I'm going to explain why it's a bad thing right now. The FTSE 100 is the 100 largest companies based by market cap on the London Stock Exchange. But the FTSE 100 has been trading sideways for the last 20 years, not including dividends. Whilst I'm extremely bullish on the future of the United Kingdom economy, especially with the upcoming Brexit and whether there'll be negotiations or not, FTSE 100 is full of dinosaur companies, such as oil and gas companies, financials, and even healthcare companies. None of these grow their dividends, and in fact the financial companies have them suspended. This means that your returns in the FTSE 100 are going to be very negligible for the time being. And therefore I'm very worried about the dinosaur companies in the FTSE 100 because they are unevenly weighted at the top, and therefore means that it could be dragging the performance of your Lifestrategy funds down. For example, this 20% is invested in a FTSE All-Share Fund. In the FTSE All-Share Fund, 5% of that is weighted into Shell. Shell is an investment that if you'd have held in the last 20 years, you would have lost half your money without dividends. And I'm not going to explain here why I don't like Shell or BP as an investment, but if you're interested, please click the card at the top right of the video. But it effectively means that your performance of your fund is going to be dragged down by these dinosaur companies that don't have much growth potential. I personally think this is more ideal for the passive investor that doesn't want to worry too much other than upfront deciding how much equities and how much bonds they would like, and then not having to worry about rebalancing the portfolio or studying certain companies and keeping up with news around them. And this effectively means that they can just deposit money on a weekly, monthly, or even yearly basis and just let it run. If I personally wanted to invest in a Lifestrategy fund with Vanguard, I would look towards a Lifestrategy 100. This is simply because I'm only 20 years old, and therefore I have a long time to wait out stock market crashes, corrections, or bear markets. And since I also have a very high risk tolerance in which I'm not worried if my money drops by more than 50%, I therefore see that LS100 would be perfect for me. However, for those of you nearing retirement that are perhaps 5-10 years away, I would probably suggest that you look for a higher bond allocation, such as the Lifestrategy 60 or the Lifestrategy 40. And if you would like a formula to calculate this, you can do 110 minus your age. My age is 20, so it would be 110 minus 20, and therefore 90% of my portfolio should be allocated to equities. If you really wanted to be clever, you could purchase 50% of your portfolio in Lifestrategy 80, the other 50% in Lifestrategy 100, and effectively you would have a 90% equities allocation, and therefore you could hit that goal. Although I suspect if you're doing that, then you're more likely more competent and probably don't need Lifestrategy funds. However, in retirement, I would suggest if you really want to keep this, I would have an income Lifestrategy 20 fund, and that way you could siphon it off and keep your capital growing. If you're interested in how to prepare for a stock market crash, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a fantastic weekend.